I learned Professor Sims since I was a doctoral student at MIT somewhere 30 years ago. You can see that I'm pretty old right now. And at that time, we were looking for a test to tell us the causalities between variables. And that time, I was told by I don't know who was the professor, the guy who's also got Daniel McFadden. He told me that you should use the Sims test. That's the first time I learned Professor Sims' name. And after 30 years, finally, I got to see Professor Sims. Professor Sims has been a Princetonian for a long time, and I hope that Professor Sims could shed some light on the future perspectives of the economies of the world. Especially, he was on the faculty with Professor Bernanke, so he may be able to see through Bernanke's mind and tell us what does he think and what he will do. And traditionally, when I was a student, we were told inflation is such a bad thing. You should never allow it to happen. But now, seems to me, this topic has changed. I'm wondering whether Professor Sims has changed the way he taught us before.
Perhaps I can give you some insight as to how to think about the problems that are before the whole world, including Taiwan, but I'm not going to have final answers for you. So let me begin. The first part of this talk is about why we need a new way of thinking about inflation and determination of the price level. Chairman Yang cited my paper, Money, Income, and Causality, which did, at the time I wrote it, support the monetarist view that money supply growth could explain income growth. But part of what I was awarded the Nobel Prize for was subsequent work that undermined that conclusion. By looking at more than two variables at a time, I was able to show that it was actually the part of money growth that is predictable and anticipated and associated with interest rate changes, deliberate policy changes, that is strongly connected to real output growth. So these new Keynesian models included a model of policy behavior. And John Taylor did an empirical study that showed that you could explain the policy behavior of central banks in many countries and many periods, including the US, by supposing that what they did was to raise interest rates when inflation started to rise rapidly, to lower interest rates when there was a recession. So if you just looked at output growth or unemployment and the inflation rate and used those two variables to explain setting of interest rate as a policy variable, you could explain most of what we observed as central bank behavior. When you took that insight, what's called a monetary reaction function or a Taylor rule, and put it into a model of the behavior of the economy along the new Keynesian lines, you came up with a complete system that could be used to analyze the effects of monetary policy and predict the economy's behavior. And for a while, this new Keynesian theory was successful. And part of the theme of my talk is there is no one single universally applicable theory of inflation. There are many sources of inflation and deflation, and it doesn't help to try to interpret the historical record of inflation through a single mechanism. Bernanke wanted the right to pay interest on reserves. If the central bank can pay interest on reserves, it can contract, it can reduce the incentive for banks to lend out their reserves without actually reducing the amount of reserves. If reserves are paying an interest rate that's competitive with loans, since the reserves are completely liquid and safe, banks will find it profitable to just keep reserves and not to lend out their reserves. So Bernanke wanted the right to pay interest on reserves so that he would have in reserve the power to contract without having to sell off assets rapidly. That's why he asked for it when he did. And that's a very important institutional change. Right now, the interest on reserve deposits is practically zero. It's 25 basis points. It's actually higher than the interest rate on Treasury bills. And then in Europe, we have a really new institutional setup, something that has never been tried before, a currency not associated with any single fiscal authority. Quite a few people in the late 90s pointed out that there could be problems for Europe with setting up a currency and a central bank without a central fiscal authority corresponding to the European Central Bank. And it's turned out that these problems did indeed arise, and we haven't resolved them yet. So a lot of things have changed, and old theories are not working very well. So let's think about some new ways to think about the determinants of inflation. So the fiscal theory of the price level can be thought of in two ways, either as another way to look at the same data. You can think about fiscal policy as determining the price level, even when the central bank thinks it's determining the price level. But you can also think about it as a logical framework in which you can analyze the necessary connections between monetary and fiscal policy. In thinking about the connection between fiscal and monetary policy, one has to start thinking about what we mean by independence of a central bank. In the US, there's a firmly established tradition of central bank independence. We have institutions set up so that though congressmen can snipe at the chairman of the Federal Reserve, they can't do much about him in the short run. And this is deliberate. The institution is structured so that it's possible for the central bank to do what it needs to do to control inflation, even when what it has to do might be unpopular. But fiscal and monetary policy do put constraints on each other. And the central bank can control inflation only if it has fiscal backing. Here's another important aspect of central bank treasury interaction, the lender of last resort function. At various times historically, there's been a sudden outbreak of widespread fear that counterparties in financial markets might default. In our recent financial crisis, banks were not a problem because we have deposit insurance, but there were other kinds of assets, in particular asset-backed securities, collateralized debt obligations, CDOs. These are all arcane jargon for types of assets that had been invented by financial innovators that had come to play a role much like Treasury bills. They were relied on by firms as things that could be quickly bought and sold. They were rated AAA. They were supposedly safe assets that could be used almost like money. And suddenly, large classes of assets like this became no longer so secure, no longer so sure, and they lost their ability to function as a source of liquidity. So it was very much like the bank runs in the 30s. Now, at a time when this kind of sudden outbreak of worry about counterparty risk infects the market, it can completely freeze up financial markets, and it did that in the United States. That was why this crisis was so severe. And the Fed intervened strongly by expanding its balance sheet. Effectively, what it did was take assets that had been thought of as completely liquid and safe, but are no longer thought of as completely liquid and safe, and say, we'll take those as collateral and lend on them, even though you can't find anybody in the private sector who's willing to take them as collateral and lend on them. And by intervening this way, the Fed succeeded in bringing markets back to life that had been frozen. So the U.S. had an effective lender of last resort, a central bank that's backed by a fiscal authority that can issue debt is the best kind of lender of last resort. A lender of last resort has to be an institution about which nobody has any worries about counterparty risk. The Now, a central bank that buys private sector securities that the private sector is worried about, in principle, could have balance sheet risk. It's possible that the Fed could be buying securities that it might have trouble selling. Its asset values at net worth might turn out to be lower than its liabilities. If it were a private bank, this would create an opportunity for a run. But for the Fed, there's no possibility of a run, because the Fed can print money, and the Treasury can provide, all the Treasury has to do, Congress has to do this, it can print up some Treasury bills and hand them over to the Fed to recapitalize it. Well, there isn't any parliament in Europe with the power to issue common European-wide debt at the moment. So, and in fact, in a really mistaken bit of policy at the creation of the ECB, it was made clear that the ECB was not to act as a lender of last resort. And the result is that Europe has no effective lender of last resort now, and won't until the question of fiscal backing for the ECB is resolved. And at different times and different countries, monetary policy, fiscal policy, real growth, and expectations of the public and financial markets all affect an inflation and are of varying relative importance in different periods and places. So let me say a few words about current policy issues from this perspective. The euro area needs a lender of last resort. I've already talked about this, to counter self-fulfilling expectations of default. The US, Japan, and the UK, anybody who buys their debt must be aware that there's a long-run inflation risk in those countries if they can't get their fiscal house in order. But in Spain, there is no long-run inflation risk because their debt is denominated in euro. But there is a danger that Spain can't print euros. There's a danger that they will just default. As I think that Italy and Spain, for example, are solvent in the long run if interest rates come back to world standards for government debt. If the ECB were to put a ceiling on interest rates for those countries and firmly intervene to enforce it, it could probably resolve the problem. But in order to do that, it would be implicitly making demands on fiscal backing of the countries in the euro area. I think Europe has to figure out how to manage these risks, how to come to an agreement about sharing such risks. They need to find a way to create marketable euro-wide security. Of course, the only reason for optimism is that the fallout of a collapse of the euro would be so bad that the politicians certainly don't want to see that either. We are in conclusion, we're in a difficult period for monetary and fiscal policy in democratic countries in general because growth has slowed, losses have occurred, who must pay or sacrifice is not yet decided. Democratically elected politicians naturally try to avoid resolving issues like this, and their reluctance to resolve them creates uncertainty and holds back growth. So let's hope for the best.